Most people think hitting £100,000 in savings is the absolute finish line. It is not. It is actually where the real financial game begins. If you do not know exactly what to do next, that £100,000 will sit in a low-interest bank account, quietly losing its value, while the cost of everything around you keeps climbing. Today, we are going to walk through the exact blueprint of what to do once you have saved £100,000 in the United Kingdom, ensuring your money starts working just as hard as you did to earn it. Let us get something straight first. If you have managed to accumulate £100,000 in cash, you have already achieved what the vast majority of people in this country never do. Recent data shows that the average person in the United Kingdom under the age of 55 has just under £10,000 in total savings. 2 in 5 Brits have less than £1,000 tucked away. You are miles ahead of the curve. You have won the first battle, but now you face a much dangerous enemy: indecision. A lot of savers hit this magical milestone and suddenly freeze. They do not know whether to invest it, pay off their mortgages, buy property, or just leave it untouched. That hesitation costs you real purchasing power every single day. Doing nothing is the absolute worst decision you can make right now. What you need is a precise, calculated strategy. Step 1 is boring but completely critical. Before you invest a single penny into the markets, you must lock in a rock-solid emergency fund. While standard guidelines often recommend 3 months of essential living expenses, the current financial climate means you should push that buffer to a full 6 months. For a typical lifestyle in the United Kingdom, a 6-month safety net sits somewhere between £12,000 and £20,000. You must park this money in a dedicated easy-access savings account or a tax-free cash ISA. Right now, top providers are offering ongoing easy-access rates between 4.5% and 5%. Remember, this is not your investment capital. This is your sleep-at-night money. It is the protective shield that prevents you from panic selling your long-term investments or accumulating expensive credit card debt when life throws an unexpected curveball like a major car repair or a sudden period of illness. Once your emergency fund is securely locked away, you must look at your liabilities. If you are carrying any form of high-interest debt, such as personal loans, car finance, or credit card balances, you need to destroy it immediately. It does not matter how tempting the stock market looks. No diversified index fund is going to consistently guarantee you a 20% annual return, which is exactly what credit card companies charge you in interest. Paying off a £10,000 credit card debt at 20% interest is the exact mathematical equivalent of earning a guaranteed, completely tax-free 20% return on your money. Once that dead weight is gone, the monthly payments you were sending to the banks turn into fresh, positive cash flow that can be redirected straight into compounding assets. Now, let us talk about the heavy lifting: long-term investing using global index fund ETFs. An exchange-traded fund allows you to buy a tiny slice of hundreds or thousands of the world's largest companies in one single transaction. For UK investors, the most efficient route is to buy these funds inside a stocks and shares ISA. You can invest up to £20,000 per year inside an ISA, and every single penny of dividend income or capital gains you generate is completely protected from HM Revenue and Customs forever. Should you dump your remaining £80,000 into the market all at once? Not necessarily. Implementing a strategy called dollar-cost averaging can take the emotional stress out of the market. By investing a fixed amount, say £5,000 every single month, you automatically smooth out the market bumps. You buy more shares when prices are low and fewer shares when prices are high, turning your wealth building into a boring, beautiful machine that runs entirely on autopilot. But there is another wealth building tool that high earners under 40 completely ignore: your pension. The tax advantages here are immense. The current pension annual allowance allows you to contribute up to £60,000 per year. If you utilize salary sacrifice through your employer or contribute directly into a self-invested personal pension or SIPP, your contributions receive automatic tax relief. If you are a higher rate taxpayer, an investment into your pension effectively gives you an instant 40% boost from the government. Furthermore, if you have not fully utilized your pension allowances in previous years, the carry-forward rules allow you to dip back into the unused caps from the 3 prior financial years. If your total pension balance is under £500,000, you can potentially move a massive chunk of your £100,000 directly into a tax-sheltered pension environment, wiping out a significant portion of your income tax bill legally and instantly. What about bricks and mortar? With £100,000, you have a substantial deposit for a residential property or a buy-to-let investment. However, property in the United Kingdom comes with serious friction. Interest rates are sitting at elevated levels, and additional properties attract a heavy 5% stamp duty surcharge. Once you factor in estate agent fees, solicitors, management costs, and the restrictive Section 24 tax rules on rental income, property requires massive effort and capital just to get off the ground. If you want simplicity and low maintenance, a diversified stock portfolio inside an ISA is incredibly hard to beat. Let us bring this entire plan together. If you have £100,000 sitting in an account right now, here is your deployment strategy. First, split £20,000 into a high-interest savings account as your permanent emergency buffer. Second, clear every single penny of high-interest lifestyle debt. Third, maximize your £20,000 stocks and shares ISA allowance for the current tax year. Fourth, look at your salary sacrifice options, or SIPP, to sweep a portion of the capital into your pension for immediate tax relief. Finally, set up an automated monthly transfer to dollar cost average the remaining balance into broad global index funds. The reason most people never build generational wealth is not a lack of income. It is because they let their cash sit in low-yield transaction accounts where inflation slowly destroys its purchasing power. £100,000 deployed correctly across a high-yield emergency buffer, tax-advantaged pensions, and diversified ISAs becomes the unbreakable foundation of your financial freedom. The difference between someone who retires comfortably and someone who is still financially stressed at 65 is simply what they chose to do at a moment exactly like this one. They had the lump sum, they had the choice, and they chose to execute a clear, disciplined plan. If this video helped you clarify your strategy, hit the subscribe button and turn on notifications. Thanks for watching, and I will see you in the next one.